Okay. Welcome to the Bear Traps Report Hot Mic Series. Larry McDonald here. Our gold friend Teddy Vallee from Prevale Asset Management is with us right now. And we're looking at the macro world, both U.S. markets and global markets. Big week. Teddy, let's kick it off. The move this week, I think, was a historic move. You had just, I think, upwards of $500 billion has left tech this week, in my opinion, and moved into emerging markets, into the global commodity complex. Teddy, what have you been looking at this week in terms of, what's your big takeaway from the price action?
Yeah, I think if you look at the growth to value spread, I think we had the biggest move over the past month since 2000, which to me seems like a pretty big tell. That there's things shifting in the background between a lot of these high growth names and some of the value sectors, which coincides with some of our longer term thinking that the U.S. equity returns are going to be quite poor versus other parts of the world and specific sectors overall. And I think that also relates to a bigger macro backdrop that's happened where over the past 10 years, you've had austerity out of Europe. You've had the U.S. consumer deleveraging their balance sheet, Japan not really doing much, and then COVID hits, and you've effectively flipped that in reverse. So the capital that's been flowing with lack of growth, horrible annualized growth of roughly, I think it's like 3.8% on a global basis per year over the past 7 to 10 years, capital's come to the U.S. because there's been nowhere to have any growth. And that's primarily gone to technology because of the lack of the growth backdrop overall. I think COVID and the response to COVID and sort of opening this, the genie's now out of the bottle with fiscal, I think creates a different dynamic going forward over the next 10 years, probably within the bond market, but also specifically with a lot of these sectors. So I think the action over the past few weeks, we've been looking for a while, probably 4 to 5 months, and it's interesting. I think it's starting a bigger shift.
Yeah. So one of the things we share with clients is that the fixed income component, the factor of the duration losses this week, when you have that kind of steepening in the yield curve, 5s, 30s, 2s, 30s, it really historic steepening in terms of the breadth of the steepening in a short period of time. With the amount of bonds on Earth, 3 or 4 months ago, we had over 110 trillion of bonds that were below 1 3/4. And you've got another 13 trillion or so in big tech, maybe 12. And so you have essentially a big crowd of deflation bets. Mm-hmm. And now with that curve steepening, inflation expectations rising, it's almost like there's a huge group of people out there that are just waking up, including the banks, right? Banks have been in denial of this commodity reflation trade pretty much the last 6 months until the last 30, 40 days or so. And so now it feels like we're coming into kind of like the maybe second, third inning of the Great Awakening but there's still, at the end of the day, the trade, a lot of these trades are working in terms of commodities, but you still have just because of that 10 years of deflation, the Fed, at the end of the day, the Fed has just misjudged the dollar's negative impact on the global economy over and over and over again. And we had just a big impact in 2016 with that move in the dollar, had a major impact on the election. Then obviously with COVID, strengthened the dollar, crushed the global economy. And now a number of academics are out there. It's almost like the academics finally understand risk management and the systemic risk that's tied to a stronger dollar. It feels like they're all trying to contain it. Is that kind of what's driving your kind of a view toward emerging markets and global equities versus U.S. equities?
Yeah, I think longer term, I think just the growth profiles, the valuations, right? EM's not gone anywhere over the past 10 years, but the earnings have grown as opposed to the U.S.
The valuation, so you're still talking like S&P at S&P valuation relative to EM. What is that spread?
Yeah, I would say on a longer term basis. So, for example, if you take like the 10-year annualized, if you take the 10-year earnings stream, average earnings stream of EM relative to the U.S., that has gone higher while prices effectively been flat. And we found that though that earnings stream or how that ratio acts drives forward returns. So going forward, because of the lack of price movement of EM over the past decade, looking forward with this shift in this fiscal backdrop, I think you have a lot of earnings potential out of a lot of the emerging markets, specifically Latin America, which we're both very bullish on, both short term and medium and long term.
And in Latin America, are you looking at commodity producing countries specifically like Chile or?
Yep, Chile and Brazil are primarily the two that we're looking at.
Okay, and then in terms of for investors watching us right now, in terms of true reflation plays on the financial side, are you looking at the Japanese banks or some of the global banks with the steepening yield curve?
Mm-hmm.
You've got some of these banks in Japan that are trading at 0.6 times book, 0.4 times book, really 60% discount to U.S. banks because of very flat yield curve over there for long periods of time. The Japanese 30 years made a big move over the last 2 weeks. Are you looking at kind of the global bank picture relative to a steepening curve globally?
Yeah, I think the global bank picture looks very, very attractive over the next, near term. I'll caveat this with near term. I think bonds probably put in a trading low within the next 1 to 2 weeks after you get sort of that bounce, and after you get that bounce, which could last 1 to 2 months. I think on a relative basis, the global fins look interesting, European banks look interesting, and I like the currency play as well over a longer period of time. But yeah, absolutely, that definitely fits in sort of the global growth upturn bucket, where those are the things that you want to be looking at and allocating to either on an outright basis, but to me right now, more on a relative basis.
And you're managing capital for family offices or financial advisors. I mean, who are your typical clients that you're talking to?
Yeah, exactly. High net worth individuals, fund to funds, family offices, registered investment advisors. We're smaller right now, so we're growing the asset base, and then we'll have a 3-year track record coming up in October, and then we'll try to move on to more of the institutional side.
Okay. You want to kick it off and take a look at the Prevale presentation?
Yeah, absolutely. And this also ties into a little bit of what we were just talking about right now. And we'll get to one of the slides, which I'll reference in a second. But overall, I think there's not really a problem with the cyclical economy. And I'll explain and get into some of the reasons behind that. If you break down, just want to make sure that the presentation's up there. I don't know if we'll be able to see it on the screen.
Here it comes. Okay, just a quick disclaimer. So my name's Larry McDonald. I'm a founder of the Bear Traps Report. We host we have an institutional platform primarily with hedge fund, family office investors. We have about close to 1,000 institutional investors in our live Bloomberg chat. And we work with clients in 26 countries. We work primarily with the buy side. We do have a few sell side clients, but it's primarily hedge funds, mutual funds, pension funds, family offices, people like Teddy, and we do have some financial advisors that we work with around the world that we send our written reports to. But what's most valuable in the live chat is really working with those institutions around the world and with the contributions from the different asset managers. I think it's really about, there's no I in team. It's about working with a large group of institutions and then trying to look at the world from a wide lens and then trying to come up with a macro investment thesis depending on, looking at crowded trades, looking at sentiment, looking at the Fed, looking at sector rotation and trying to find value in the world. Just a quick, just reading here from the disclaimer, the Bear Traps Report research publication is not paid by any company to recommend securities to investors. We're completely independent. This presentation is for educational and informational purposes only. It's been compiled and arrived from sources that we believe to be reliable. but we make no representation or warranty and express no implied guarantee of its accuracy. But just take a look there at the disclaimer, and let's kick it off. Next slide.
Yeah, just a quick plug for Bear Traps. Myself and my team absolutely love it. The amount of information that's in there and content on a daily basis is, I mean, there's so much that it's it takes a little time to get through, which is great, and it's very thought provoking. So kudos to you and everyone at Bear Traps. Oh,
thanks. Yeah, it's really been a pleasure working with you and the different clients around the world, and we enjoy the process. So let's go through here. Okay, we can
flip it. So let's flip to that next slide, please.
Okay.
All right. So this is a little bit what I was talking about before, where we don't really think there's a problem cyclically with the economy. So typically coming out of a recession, financial conditions are tight. There's a lot of difficulty getting things going. Those conditions are not necessarily present today. We think primarily the reason that we've had such a difficult time is because of the shutdowns, because of the virus. And you can see that in the jobs data. So for example, leisure and hospitality today makes up 40% of all the jobs that have been lost. If you go back to the prior recessions, 2008, that was roughly 9%. In 2001, that was actually net job gain. So on the cyclical side, however, the total cyclical jobs lost, whether that's manufacturing, construction, and trade, is only 9% of total jobs lost today. Where in 2008, that was 48%. And in 2001, it was over 100% of jobs. So from just the breakdown of current job losses, it's clear that the policy response due to the virus is what's causing the unemployment rate to be so high today, and a lot of the problems and slowdown that we saw over the past few months. If you could slip to the next slide, please. So this is another example of how we're really not cyclically impaired. Last year, total bankruptcies in the U.S. were down 30%. Coming out of recession, you would expect bankruptcies to be up materially, but given the response to COVID and what the government has done on the fiscal side, we've seen incredible numbers like this. On the next slide, please. This has been referenced a lot. The Goldman Sachs Financial Conditions Index right now is the easiest it's ever been. Again, not something you would expect coming out of a recession, especially the velocity of how fast.
So, Teddy, I want to add something here.
Please.
So what's interesting, now this slide was taken probably maybe a week or two ago, but there was a big reversal this week. And I want to make sure everybody understands that the move in rates has such a big impact on financial conditions. And financial conditions are still very accommodative, but the reversal this week and over the last 5 days with that 30-year and with that 10-year, remember Goldman Sachs year-end target for the 10-year, we've already crossed it by 6 basis points. So I think we touched 140 today. I think Goldman was at 130 back in January. So the street is massively underestimated this rate move. And you got to remember back to 2018, obviously the Fed was hiking, so it's a totally different environment, but rates were moving up, and that's what really tightened financial conditions. Financial conditions will have a very big impact on cryptocurrencies. This is the kryptonite of cryptocurrencies. If financial conditions tighten, you're going to have a big impact on cryptocurrencies, because when financial conditions tighten, you just don't have as much liquidity as really a need for a very liquid and transparent crypto market. So what we've seen over the years is every time financial conditions tighten, you get some type of activity there, negative activity in the crypto market. But overall, this Goldman Financial Conditions Index is something the Fed is watching very closely. And if they're trying to hold accommodative policy, very accommodative, and financial conditions are reversing against them because of the reflation trade, that's something that would cause the Fed to push in yield curve control. And in our chat, and when talking to people like Teddy, we have daily discussions about where the Fed would come in And many clients that I respect on the rate side think the Fed, if we get a fast move to 150 on tens, the Fed steps in and then comes in with yield curve control. Because right now, with the move in tens and with the move in 30s, you'll see over the next 2 weeks, if yields stay up here, financial conditions are going to tighten a lot more. This chart's a little old. If you look at a live chart today, there's a lot more tightening than you can see on this chart. And this is the type of thing that is going to force the Fed into yield curve control. And you're going to have a big impact there on gold and silver and a whole bunch of different asset classes. But that's just my 2 cents on the FCI index.
I would also make another point on that. This, if you overlay this and invert it with price to book multiples of the S&P or a lot of these high flying sectors in technology, it's effectively 1-to-1. So as rates go higher and as financial conditions tighten, that's going to significantly compress multiples, which is sort of a theme that we're thinking about going forward, which I'll get into also a little bit.
Yeah. So the tech problem you're seeing this week, a really historic shift over the last 5-6 months. You've had tremor after tremor after tremor, assets moving from growth into value. And this week there was a little bit of a quake, and that's really driven by rates. Your NASDAQ stocks, many of them are deflation bets. People don't realize when you're in your typical software NASDAQ stock, those are massive deflation bets. And your net present value of future cash flows with rates spiking is worth a lot less. So that's why the NASDAQ and the growth stocks this week have really struggled to keep up with. I mean, just today, and you look at Boeing, you look at Caterpillar, Chevron. These stocks are up 4, 5, 6, 7%, and the NASDAQ was struggling all day, down 1-2%, finished up a little bit. But net, you're really seeing trillions of dollars move from growth into value, and we're really looking at a new decade ahead with much more inflation risk than the previous decade. Next slide.
Totally agree. Yeah, so this again just goes to show effectively we're not seeing typical things out of a recession. Right now, trucking rates and rail volumes are back to their pre-COVID levels and above that. Next slide, please. The core retail sales print that we just had was 12.8%. I'm sorry, I think it was 11.8. That could be a typo. Regardless, it's the highest print that we've had since 1995, or effectively since the data's been around. These numbers are huge, and I think are part of the unintended consequences of what could potentially be a larger policy error from both the Fed and from the fiscal authorities. So next slide, please. So effectively what this is it's a model that we created we focus a lot on leading indicators over the next, call it 12 months. Those get confirmed by shorter leading indicators and then finally by what we call a RealTime PMI. RealTime PMI is an aggregation of 30 or so different market internals, call it copper to gold, EM currencies to bonds, those type of things. So, financials relative to the S&P, financials relative to the Utes. Right now, the index is effectively showing that we are in a full cyclical global upturn. Now, this is as of today. The breadth of those, there's 100% of the ratios that we follow are above their longer term moving averages. So today, the markets are telling us that we are seeing a full cyclical upturn. This is in the face of 10 million that Powell was talking about unemployed, and because the unemployment rate is very lagging, it's the most lagging economic indicator, and hyper focused on that and not understanding the composition of the jobs lost. I think that they're setting up on the fiscal side for potentially some very large unintended consequences as we progress through this year.
Yeah, exactly. So our partner in Washington is ACG Analytics, and they've done a fantastic job. They nailed the Senate. Now with a 50-50 Senate, people don't understand with reconciliation, you only need 50 votes. And with a 50-50 Senate, and you've got a Fed and a House and a Senate that are much more open to MMT experiments, all this opens up an entirely new regime, whereas 10 years ago it was all about Brexits and trade wars and tea parties and, COVID and COVID last year and it's into this year. But going forward, they're all drinking the MMT Kool-Aid. They all want to experiment, and they really don't have any idea of the true unintended consequences. There's a real serpent in the market. There's a beast in the market. And when you have this cocktail of, another $2 trillion of fiscal policy, which because of COVID will be much easier to pass, but because of reconciliation, you can also follow that up with an infrastructure bill. There's potentially two. And I recommend you talk to ACG Analytics in Washington if you set up a meeting, and we're happy to set up those meetings. But there's the potential this year for 2 reconciliation bills. I want to emphasize, you don't need 60 votes to pass legislation in the Senate with a reconciliation bill. It's 50 votes. That's why the bond market is trying to swallow and digest this real big surprise. I mean, most investors globally don't understand what's really happening in Washington. And what happens in Washington is the biggest global driver of risk. And this reconciliation bill on the COVID of 1.9 trillion that we're going to see move through the House this weekend, the Senate next week, and by the 14th of March, we're probably going to have a bill. And then because we're still coming out of COVID, the probability of passage of another, traditional infrastructure bill is also there as well. And so that's why, being in a portfolio of the previous decade relative to the decade looking forward is like 2 totally different worlds. Next slide.
Yeah, Larry, just quick question for you on that point. What do you see the probabilities of them being able to get through that second infrastructure package, or what does ACG sort of think on the reconciliation process? Is that difficult, or is that a pretty high probabilistic outcome?
Yeah, there's most likely going to be what happened. John East is probably the best analyst I've met on, down in Washington. He calls reconciliation fool's gold. And what happens is, because you only need 50 votes, there's a tendency to throw very, very aggressive things into the bill, and which can cause some difficulties. And like you look at tax cuts. I mean, the Republicans were supposed to pass tax cuts in the first quarter of 2017, and ended up passing in the fourth quarter. So there's a lot of, and you look at Obamacare. After President Obama was elected with one of the most powerful majorities in the last 20, 40 years. And we still only had Obamacare with reconciliation passed in the fourth quarter. So most likely you get an infrastructure bill, but it's probably you're going to have some type of what'll happen is there'll be just 2 aggressive moves on probably the Democrats trying to position spending in there. There'll be a fight, a breakdown. One thing that John and ACG pointed out to clients this week was the Republicans, they need those centrist Republicans, even though it's only 50 votes, you still potentially might lose a Democrat or 2. You still might need 1 or 2 Republicans. And the way the Republicans were treated on the Hill this week, Murkowski, Collins, it didn't bode that well, right? I think near term for a second bill. So you get a first bill and then probably a hang up, and so the market will have a reflation digestion period through the spring and summer.
Got it. So today, from that last slide, the global PMI is straight from the lower left to the upper right, which is saying today the cyclical global economy is very, very strong. So now we're looking at over the next, call it 12 months, and we think there's a potential for a 12% nominal GDP print, which I'll walk through now. So based on our leading indicators alone, as you can see below, this leads US GDP by about 12 months. This would augur for anywhere from 5 to 6% of GDP. We're assuming that only 30% of this comes through. 60% of this comes through because of some of the issues with COVID, reopening, some things that potentially, make it difficult to really have this model historically be 1 for 1. So I think roughly 3 points from this makes sense to us. looking forward just from our leads alone. So if you could flip to the next slide, please. So something else that we've done a lot of work on and thought about was the amount of wealth increase in the US. So the chart on the right is the increase in total household net worth, which is up $13.5 trillion pre-COVID. So call it February from the prior high. We found that this leads consumption by roughly 6 to 9 months. The current rate of change, as you can see there on the right.
Is that pink diamond the number there?
Correct. So the current, assuming the historical relationship between the two, the increase in net worth would apply roughly a 9% GDP handle. We think that's probably going to be coming close to 30% of that, which gets you about another 2.7% of potential GDP. That in total between the two of them is roughly 5.7%. So you're already starting to see that because of the focus, what the Fed has done, the amount of liquidity injections, the increases in equities has really lit a fire under a lot of these equities and the net worth, and the people that spend the money or drive the most of consumption are the ones who hold equities. So over the next few months, we think it's pretty likely that this drives consumption pretty higher.
See, Teddy, this tells you so much because, once again, the Fed is the great inequality, maker, and
correct.
They're trying to do their best. They kept us out of a really bad recession, but the other flip side of that is you create this inequality, and the flip side of that is in Washington, this just feeds into MMT, it feeds into universal basic income, feeds into all this type of fiscal policy that really didn't exist in the post-Lehman era. Our book's now in 12 languages. I'm very proud of it. Colossal Failure of Common Sense. It's one of the best-selling business books in the world. It's a New York Times bestseller. And, it's one of the things we wrote about in the book is that fiscal response back after Lehman was really politically contained. And now this type of COVID dynamic with expansion of inequality, you just have a much more social justice Fed. You've got a much more, Yellen lobbying Congress. And if you watch the hearings yesterday, you're just going to have a much more aggressive sales pitch toward fixing the inequality buffer by using Fed policy and fiscal policy combined with new creative tools to try to fix this inequality bucket. As you can see, that pink diamond says a lot about the next year in terms of Washington fiscal side.
Mm-hmm. Totally agree.
Next slide.
So the third to last is effectively the amount of cash that's on the sideline in consumers' pockets. So because of these programs, interestingly, income was up significantly last year just due to the fiscal stimulus and the payouts, the transfer payments. So right now we're seeing that personal savings is about $950 billion above its 10-year average, or that's about 4% of GDP. Historically, when you've had such a large amount of personal savings relative to the 10-year average, that gets drawn down. So we're assuming as the economy opens up and people can come out and go and spend again, that will likely come down. And I think our assumption on the next page, please, is for roughly 30% of that to come through.
Next slide.
So on page 11 here, we basically broke down the three main areas as well as the Biden proposal. So in total, the past stimulus was about 4%. The Biden proposal is roughly 9% of GDP. We think probably it's fair to assume 30% of that comes through. And then comps are likely good for about a point year on year, just given that we were down last year. So that's effectively 32% GDP potential over the next 12 months. We think you're probably going to get around 11.9 to 12, which is double what the Fed thinks. I think a little more than double or a little less than double what the street thinks, and likely going to have a very large implication. We put this work together roughly 3 weeks ago. And the view was the unintended consequences of the monetary policy is going to cause very, very big moves in the bond market. that rates at the time were 90 basis points, 1%, 1.1%, that made no sense given what our real-time PMI was saying today, but more so what we're seeing for the next 12 months with a few of these charts.
Teddy, what's your view in terms of when the Fed comes in on yield curve control?
Yeah, so I don't know if I have the same view as you on yield curve control. I think it's difficult for them to, given that they're basically the global central bank, I think it's difficult for them to come in and cap rates if things are moving in a good direction because of the amount of capital that would be sold to them that would then really, really blow up their balance sheet. I think if they do cap, they'll probably cap 3 or 5 year rates. I think it's probably going to be difficult for them to do longer duration. If they do, though, and it's clearly a decent probability, if they do, though, I think gold miners and silver miners are probably going to go up, 300, 400%, given this backdrop, given where real rates would go after that. But I think it's difficult for them. If we get a very, very hectic move in the bond market, I think above maybe to 2 in the near term, they're going to recognize that that's not going to be good. But I assume they would probably increase their asset purchases first to try to use a little forward guidance to try to tamper things down before putting in actual yield curve control. However, if things fall and this is all completely wrong and things are deteriorating, I think then they could start thinking about putting that in to make sure to hope that things pick up again. But I think it's difficult for them to do so with things improving so much. I don't really know how they would sell that. And
well, that's why it's so important to watch the financial conditions. So to your point, if things are growing, if we get this beautiful backdrop of GDP growth, really the reflation trade goes into the next year. And if all of this translates into tighter financial conditions while they're doing 120 billion of accommodation a month, that means that they have to adjust. So yeah, I agree with you. If financial conditions stay really, the Goldman Financial Conditions Index, one of the bellwethers that we look at. But if the financial conditions stay the way they are, the way they have been the last, 3 or 4 weeks, then they're fine. But if financial conditions tighten and the market's really tightening for them, then that forces kind of the social justice Fed into action. So that's why I think watch the relationship between. That's why these charts have been so great, because this chart is really showing a robust potential GDP backdrop. But the question is, will that translate into tighter financial conditions in the market, which will then force the Fed's hand into yield curve control? Yeah, go ahead, Teddy.
No, I think it's going to be super interesting it's a great point. I think it's going to be super interesting to watch sort of the velocity of the bond move and how that plays into the financial conditions, because that's, their third leg or whatever it is to constantly monitor. So if that really gets out of hand, then, we could see even more crazy type of things from the Fed, which at that point, I think one would really need to think about silver, gold, and, sort of inflation hedges, because if you're not going to allow the market to, the whole process of rising interest rate is to dampen the growth a little bit, calm things down. If you're letting things really rip, then real rates are going to, inflation is going to really rip, and real rates are going to get crushed. And you started to see that a little bit previously with the mortgage rates. 30 years were bouncing and mortgage rates were at the lows because of what the Fed's doing with the MBS. Recently, that's gone the other way. But if you really cap those rates, then there's going to be a huge trade, I think, in a lot of the commodities.
Yeah, commodities, global cyclicals, global financials, Japanese banks, European equities. The UK ETF is EWU. We've been watching that carefully. We've got a number of holdings in there that are global cyclicals that really take advantage of kind of a reflationary, global reflationary environment. Next slide, please. So
given sort of that backdrop of where growth is likely to head, we think that the bias of rates is definitely higher from here. Assuming that assumption is correct, higher from here, this is as of a few weeks ago when we put this together. Near term, like I mentioned, I think there's probably a tradable low in the bonds near term based on some of the technical work that we do. However, I think the progression of rates over the next 12 months is higher. I think you can see 2 to 2.5. And under that assumption, the U.S. equity market is going to have a very, very difficult time, to a point that you talked about previously, of this deflationary and defensive market cap. Right now is roughly 69% of the U.S. equity market is in technology, utilities, healthcare, the things that do not do well with rising interest rates and increasing growth profiles.
69% of the market cap
of the S&P and the Russell is composed of the sectors that are we've categorized as deflationary.
So essentially 70% of the equity market is positioned for the last decade that we just looked at.
Correct.
So
exactly.
I think that's the problem, ladies and gentlemen. The last decade was Brexit's, trade wars, COVID's, tea parties, no MMT, very hawkish fiscal policy around the world. This portfolio that you see that Teddy put up here is really designed for that world. It's a deflation world. Every other month in the last 5 years, every other quarter, we had a deflation scare. We got to the point in where cold winters would take GDP into close to negative territory. So if you're in an environment like that, Brexit's, trade wars, tea parties, COVID, Fed doing taper tantrums, all those things are very deflationary. All those things are very strong dollarish. And so that you can see, this chart is a beautiful representation of 10 years of a market psychology that has just been pounded away into these sectors. And that's, I think, what's happening this week is that audience right in front of you, that's 70% of equity market cap. It's the audience, the entire theater, everybody's in the same trade. They're all in deflation bets. And what we've seen in the market the last 2-3 weeks, last couple of months, but especially this week, this crowd that you're looking at on this page is waking up. They're waking up and they realize that their portfolios are positioned for a lost decade, not the decade in front of us. And that's what I think is the big wake up call in the market this week.
Absolutely. So next slide, please.
Yeah, there we are. Okay.
Looking forward, to us, the areas of the market that look super interesting are the ones that correspond to higher real rates and higher, effectively, basically increasing global growth. So if you look at the correlation between multiples, we've just used price to sales here primarily because it's the most macro, given that given sales are very macro from a top line basis. The areas and things that you want to look at are Latin America, EM, financials, energy, things that do very well during global growth upturns and persistent levels of higher economic growth. Now, as it relates to the last slide as well, energy right now is up from 1.7% of the U.S. equity market to a little over 2%. So in terms of potential upside, there's a significant amount of upside. We think that our energy EBITDA probably prints the 2018 high, which gives it roughly 50 to 60% upside from here, assuming just a average 5-year multiple. So same thing with Latin America, which also, to your point, is very, very commodity oriented, and also gets another kicker from the currency tailwind. These are the areas of the market, in our opinion, that are going to do well relative to the deflationary defensive equity holdings, primarily the technology component.
So I just say on that, Teddy, so people have to understand the rig count today is like in the low 330, 320. The Baker Hughes, rig count, the global rig count. So what happens is when you come out of a recession, normally production in terms of U.S. production and global production, because that rig count, because the CapEx, we've had like $2 trillion that's come out of capital expenditures, that's research and development, that's exploration, 2 trillion's left. Everybody knows that. But the wake up call is when you take that type of CapEx out and you go through an environment where, ESG is ruling the land and you're looking at Green New Deals. And so all of these things together have really scared, massive amounts of capital away from energy investments. And so you're talking about, we said this in October, and we said it in January, and now the street's very, very much waking up to this call. You could be 3 to 4 million barrels a day undersupplied by this time next year. And if that's the case, you just don't have the R&D, the exploration, the investments to find that new oil. And the Saudis have a couple million barrels a day in their back pocket, right? They have that. They're probably going to turn that on here in the next month or so, and that'll hold things down for a little while, right? That'll probably knock oil back. But once demand normalizes, I mean, our travel budget alone for bear traps, we normally visit around the world, 12 cities a year. We go to London at least once a year. We go obviously to other parts of Asia and to Zurich, and last year Calgary and the West Coast. So our travel budget was down. 2020 was down 90%, and we're already, just our company alone, we're already booking trips for like at least 50-60% back, and then by early next year we'll be 100% back. So if that's the case, you're going to have like a real dynamic in the world where we're undersupplied, and you've got regulations coming out of Washington, unintended consequences. Today, President Biden was dissing MBS, the prince, Saudi prince. And so I can just smell, we're up, oil's up 80%, 70% since the election. And, we've had a number of executive orders, and just always be wary of the unintended consequences of politics and markets and COVIDs. And it just is it could be a pretty nasty cocktail. We could be having, like an energy crisis a year from now. And that's why, this portfolio in front of you, this equity multiples and breakdown of the marketplace, energy is, 2% of the S&P. I think it's crazy, but it's just the results of a massive ESG, COVID, just the capital has, Green New Deals, capital has just run from this part of the world. But I think we're all heading for a big wake-up call. But next slide.
Yeah, and this next slide encompasses exactly what you're talking about. So what we've done here is we've taken E&P names and looked at their CapEx relative to their assets, which is that black line there. It's left-hand scale inverted. And effectively, there's been such a low amount of CapEx amongst these guys relative to their assets that the supply that has historically led to the returns of crude, because the supply has been so poor, by about 2 years. So the 2 year, looking out 2 years, the annualized returns for crude are phenomenal. And this is likely going to continue to trend lower given some of the things that you were just speaking about, with ESG and the new focus here. So the supply side of energy is very, very bullish for the price. And if we are right at all on the forward 12-month view for growth, you have a very, very poor supply picture with an unbelievable not a lot of oil coming online, with an unbelievable demand pickup. You have potential very, very big upside moves in crude.
What's the blue line, Teddy? The blue line?
The blue line is crude 3-year annualized returns.
Okay.
So the 3-year annualized of crude.
So what this is looking at is, it's looking at, over the last, since 2000, when you get that pickup in R&D.
When you get the drop off in R&D relative to assets.
Well, that's the drop off.
Yeah,
okay.
Inverse. I inverted over there.
That's why. Okay, so that's a drop off in R&D.
Right.
I see.
So effectively, less supply coming onto the market.
Okay.
So as there's less supply coming on, as they're not investing in the resources to build out supply, less supply coming on the market, which drives the forward 3-year annualized returns for crude.
I see. So the black line, what's your left axis?
Left axis is the CapEx relative to assets.
Yeah, and that's why you can see just want to make it's a little confusing, but
yeah,
that's why it's
I
inverted.
need to make that one clear.
You can see the numbers; it's inverted. So when you're moving up on the black line, that's CapEx collapse.
Exactly, which leads crude by about 2 years.
And all that means for people watching, it's like capital expenditures collapsing, and then all of a sudden you don't have enough exploration, you don't have enough rigs, and then when there's a snapback in demand because of, say, vaccines that are very effective, then all of a sudden you have a problem. That's why you don't want to insult the crown prince.
Yeah, exactly.
Okay. Next.
Yeah, this last slide here is effectively, so we would be looking to, fade the defensive assets and deflationary assets and own, the more cyclical aspects of the market like energy. The reason we'd be fading some of the other things is, as you can see here, this is tech PEs versus 10-year reals. This chart's a little old from when we put it together, but effectively, as real rates rise or interest rates rise, multiples compress. So the biggest driver of a lot of these defensive and deflationary names has been the rise in the multiples, which is primarily due to lower real rates, also financial conditions, which we mentioned earlier.
So really walk us through this. So as real rates rise, what's happening to tech on this chart?
Exactly. So right-hand scale is real rates, 10-year reals inverted. So as the black line goes down, that means that real rates are rising, which is what we've seen over the past few weeks. On the left side, that's tech PEs, so price to earning of the technology sector. So as real rates rise, i.e. on this chart inverted going down, then tech multiples also go down. So people are less willing to pay up for tech because growth prospects are improving. And we've just outlined a scenario where the growth prospects are going to be very, very strong. So you could get a significant re-rating in the multiples of a lot of these tech names.
Yeah, and I was joking with Ed Bradford on Twitter the other day, but people don't understand. Many tech companies are just long-term zero coupon bonds. That's what this chart shows you. People are less willing to pay up for tech. Really sophisticated pension funds, asset managers in a deflationary world, they want to pay up for tech because the net present value of those cash flows is worth more. If you have certain deflation for 5 years out, you want to own Microsoft. You need to own those 10-year cash flows from Microsoft, Netflix, or all these software companies. You can make the case that those stocks should trade at 30, 40 times earnings in a certain deflation world. But once you bring in the element of inflation risk and rising inflation and higher real rates, that's a big problem for tech because your net present value of those cash flows is worth less. And so that's what you can see on this chart, where the multiples come down in the marketplace through history when you have higher yields.
Exactly right.
That wraps us up?
That wraps us up on the Prezi.
Okay. Well, I think we went, let's see, we went about 45 minutes. Good job. Once again, just to wrap things up, my name's Larry McDonald, creator and editor of the Bear Traps Report. We work with institutional investors around the world in 26 countries. We have a live Bloomberg chat. Our clients are primarily institutions and some retail financial advisors as well. And Teddy, just give us a little background on your view for your company. Looking out over the next couple of years, where do you want to take things?
Yeah, so right now we run a global macro hedge fund. We trade across stocks, bonds, currencies, commodities, and cryptocurrencies. Ideally, over the next year, 2 years, we'd like to take it to 100 million to 250 million of assets. We have 4-person team right now and just building it out and working our way towards that. Okay. Well, it's inspiring. Thanks very much for joining us. Thank you, Larry. Thank you very much for having me. Everybody out there, we'll see you at the top next time. Thanks very much for joining the Hot Mic series. Bye-bye.